This is a clip from a previously recorded full-length episode. Please visit milkshakespod.com for more information and access to the full-length original recording.
Yeah, so if you look at, and this has gotten a ton of attention, the bond we've had like a 30-year bond bull market, and then in the last couple of years, bonds have largely just gotten crushed, for lack of a better way of saying it, right? The U.S. Treasury, whether it's the 10 or the 30, depending on where on the curve you are, but it's down anywhere from 25 to 35% over the last 18 months, and that's a huge drawdown. And so a lot of people have attributed that to the huge budget deficits and not only that, but we've got the twin deficits and we've had to have all these bailouts and we've printed all this money. And so, this is just another argument that the U.S. is on death's door. And the point that I've pushed back on is, it's not great that Treasury prices have fallen if you are a Treasury bond holder. But this is not by accident. And the level of bonds falling, considering the level of interest rates that have been hiked, it is not unusual at all. And so I've had a couple discussions where people are saying, oh, it's different this time. This is clearly, the world is rejecting treasuries. Well, they're rejecting treasuries at 0.5%. Yeah, they want to get paid 5.5%. And as a result, bond prices have gone down. But again, this is nothing new. I sent out a Twitter thread today, gone back to the 1970s. The last time we had a very big, large rate hike cycle that this current one is being compared to was in the late 70s. And so from the late 70s until now, there's been 7 rate hiking cycles. The big one was in the 70s. There was a couple in the 80s, a couple in the 90s, and then, one in the early 2000s, and then one now. If you go back and you actually look at what happened during those time periods, every time Treasury bonds fell precipitously. There was a couple times where they fell 25 to 35%. That's exactly what's happened this time. And this time we've hiked rates faster than at any time before. Not only that, but I think the previous amount that we had hiked is, I've measured it a couple different ways. You have to go to the Twitter thread to see it, but the fact that rates went from 25 basis points to 5.5% in a year and a half, that's a 2,000% increase in interest rates from where they started. It's 5.25% on an absolute level, but from a growth perspective, it's a 2,000% growth of interest rates in 18 months. Considering that, and just doing simple bond math, it's not shocking to see a long-term U.S. Treasury bond drop 35% under that scenario. Not only that, but this has literally happened every time before. Every other hiking cycle, you saw long-term bonds fall. Here's what was kind of interesting when I did the analysis too, is a lot of people say, well, as soon as interest rates start going up, you should sell bonds. Or you got to sell stocks. Higher interest rates is bad for stocks. Well, the reality is the S&P 500 went up during every one of those hiking cycles. Now, it didn't go up a lot, and a lot of times it went up kind of at the end because people were anticipating lower rates, very similar to what's happened in this last time period. But the reality is if we look at all the 6 previous rate hiking cycles, over the period of rate hikes, the S&P actually was either flat or up in all of them. So far this time, the S&P is down 5%. Now, again, that was over the life cycle. There were periods in those previous life cycles or those rate hike cycles where equities were initially down and then rose in the end, which is kind of similar to what's happening again now. So this is very, very similar to what's happened in the past. There's no mystery here. It's very explainable. And so I'm not saying that it won't be different this time. I'm just saying so far it hasn't been. And so it's important when people tell you that this has never happened before and this is a sign that the world is never going to buy treasuries and this is a really bad sign for the U.S. Well, it's not a good sign for the U.S. But again, people said this every other time that this happened because this has happened pretty regularly. It hasn't, but because interest rates were so high in the 70s and were so low a year and a half ago, there was basically a 40-year bond bull market, but there was a couple bear markets along the way inside that overall bull market. It's just that people who have now been working on Wall Street for 10 or 15 years have never seen it before, right? There's not too many people still working on Wall Street that were here in the late 70s or early 80s when we had these previous rate hiking cycles. And so, this again, it's important to understand how it could be different this time, but it's also very important to understand that it's not necessarily different this time. And so far, it's not different.
This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.